On April 8, 2026, Governor Sanjay Malhotra convened the first Monetary Policy Committee meeting of the new financial year. Looking at the official rate card from that meeting, the committee voted unanimously to hold the line. The benchmark repo rate remains at 5.25%. The standing deposit facility stays at 5.00%, and the marginal standing facility holds at 5.50%. Alongside these held rates, the RBI officially adopted a neutral policy stance. In operational terms, a neutral stance removes the restrictive bias of the past cycle. It grants the central bank the mechanical flexibility to adjust rates in either direction as new data arrives. That flexibility is necessary because the domestic pause is happening against a backdrop of severe, unpredictable global supply chain shocks. At the top of that list are escalating geopolitical conflicts in West Asia, which are directly bleeding into global energy markets. Despite these incoming pressures, the RBI declined to deploy proactive rate hikes to preempt inflation, nor did they cut rates to stimulate growth. Governor Malhotra's wait-and-watch directive is an engineered equilibrium. The committee is balancing a heavily capitalized domestic financial sector against exogenous threats that cannot yet be accurately quantified. To understand the RBI's calculus, we have to isolate the domestic baseline. Internally, the Indian economy is absorbing the current rate environment well. This chart tracks the official GDP projection. Growth is expected to step down from 7.6% in FY26 to 6.9% for FY27. That is a controlled deceleration, not a stall. The stability of that baseline is evident in the financial plumbing, specifically within non-banking financial companies. These institutions are reporting improved gross non-performing assets and strong capital adequacy. The domestic credit engine has enough liquidity to function effectively without the stimulus of a rate cut. Because the domestic side is stable, the RBI's defensive posture is entirely dictated by external variables, beginning in West Asia. Ongoing disruptions in the Strait of Hormuz are heavily restricting the flow of commercial shipping. This visualization maps that choke point directly to global energy costs. The disruption has forced crude oil prices above $111 per barrel. Compounding this energy shock is a secondary, climate-driven threat: El Niño weather patterns forming in the Pacific. An intense El Niño disrupts the monsoon cycle, directly threatening India's agricultural output and raising the probability of sudden spikes in food prices. The RBI's policy constraints are born from these exact vectors. They are defending against imported inflation and climate shocks, not domestic structural flaws. Sustaining $111 crude oil shifts the balance of India's international trade, placing a direct burden on the nation's payment obligations. We can see the mathematical consequence in this formula. Extremely high import costs for oil directly widen the current account deficit. That deficit is under further pressure because slowing global demand triggered a 0.2% contraction in merchandise exports in early 2026. The sole structural floor preventing a severe widening of this deficit is the continued resilience of remittances from Indian workers in the Gulf countries. This combination of high oil and food risk has triggered a sharp analytical dispute between institutional markets and the central bank. This chart breaks down the Consumer Price Index. Markets have lobbied the RBI to base its rate decisions on core inflation, which sits at a highly manageable 4.4%. But core inflation looks benign because it mechanically strips out the prices of food and fuel. Governor Malhotra explicitly rejected the market's request to use this metric during this specific policy cycle. The El Niño threat targets agriculture. The Hormuz disruption targets oil. The two primary risks to the Indian economy map directly onto the exact categories core inflation ignores. Discarding food and fuel data right now is institutional blindness. That is why the RBI insists that headline inflation, currently projected at 4.6%, remains the strict operational target. A widening current account deficit typically invites global capital outflows, triggering volatility for the Indian rupee. Historically, central banks are forced to hike interest rates to aggressively defend their currency's value during outflows. The RBI, however, refuses to use the 5.25% repo rate to artificially manage the rupee. Instead, they defend the currency using India's foreign exchange reserves. As of April 2026, the RBI amassed a reserve wall totaling $696.1 billion. They intervene only to absorb excessive volatility and allow efficient price discovery, not to force a specific structural exchange rate. Governor Malhotra highlighted this specific buffer to contrast India's current resilience with past market panics. During the 2013 taper tantrum, currency defense consumed policy. Today, the scale of this reserve pool insulates the domestic economy from immediate shock. By utilizing the reserves as a systemic shock absorber, the RBI frees its interest rate tool to focus exclusively on hitting that 4.6% domestic headline inflation target. Look at the full macroeconomic matrix the MPC faced in April: $111 crude oil, a widening deficit, and severe climate risks, mapped against 6.9% growth and a massive capital buffer. In the center of that system is the 5.25% neutral repo rate. Given the data, this pause at 5.25% likely represents the localized peak of the tightening cycle. The governor reinforced this by offering specific forward guidance on where rates go from here. This graphic highlights his statement that interest rates will likely stay lower for longer in the medium term. But that projection is highly conditional. Rates will only stay low if the 4.6% headline target holds up against the real-world impact of the Strait of Hormuz and El Niño. The RBI is not launching a proactive offensive. They have engineered a system of defensive absorption. They are relying on two deeply fortified pillars to handle the impact: the $696 billion reserve wall and the domestic credit market's capital adequacy. By securing those buffers and refusing to target flawed, stripped-down inflation metrics, the RBI has purchased the ultimate policy luxury in a volatile global economy: the time to simply wait and watch.